Hello everyone and welcome back to the channel. In this video, I am going to explain all the things that you must understand before you trade in the money covered call, okay? And this will be a proper strike price selection. This, guys, it is just a video in relation to one of the questions that I did receive in this video here, which it is how to make huge profits within the money and out of the money covered call strategy. If you haven't watched this video, come here to our channel and watch this before you watch this one, okay? And this is the question from Be Good to Do Good, something like that, and how to select the strike price and how to select the stocks. In this video, I'll be focusing more on the strike price selection. Why? Because I mentioned to you guys many times, especially for those of you that are starting trading options. Why now? Stick with ETFs, and I'm gonna show to you guys here the example that we're going to use, which it is IWM. In my point of view, it is one of the best ETFs you can trade, of course, together with the Triple Q, with SPY, and so on. If you have a small account, guess what? Go to XLU, XLP, XLI, XLF, and so on, okay? And of course, we are going to go through some examples, okay, in a spreadsheet here to show you guys the things that you need to have before you press the trigger. And one of them will be, of course, our annualized rate of return. And in this Google Sheet, we're gonna simulate here a lot of stuff, different strike price, different premium, out of the money, in the money, break even, caution, protection, all those good stuff. Because when it comes to trading option, guys, there's only two things. You can collect a lot of premium, and the thing is, you're gonna have way smaller protection. You can collect a little bit less premium and you're gonna have way more protection. It's up to you how much risk averse you're going to be, okay? And by the way, for those of you that never trade option before, guys, go to our channel and watch this playlist going from zero to here. If you want to learn how to trade options, this is the best playlist. And by the way, I'm going to update this on a monthly basis. And for those of you that join our Discord group, you're gonna get all the latest video in this playlist, okay? But here on YouTube, I've got everything that you guys need to know and must know before you pressing the trigger when it comes to trade options. And of course, we have here a lot of contents, guys, which you can watch and learn as well, okay? So the things that we're going to cover today that you must learn from the top of your head when it comes to trading in the money covered call are the first thing, guys, premium capture. How much premium you want to collect? Of course, are you greedy? Are you more risk averse? Where you want to put your strike price? Do you want to put your strike price close to the money, out of the money, very deep in the money, very out of the money? The choice, it's yours. And of course, annualized rate of return, which for me, it is one of the best things we can take in consideration, not just for the covered call itself, but for cash secure put or any other option strategy, because this gives us, let's say, a ballpark how much we're getting in the money that we're gonna put aside to trade the particular strategy, okay? Of course, as you know, I'm not a big fan of TAs, fundamentals, things like that. I do use for engagement purpose only, and of course, to go along with all my long-term investing analysis and approach. But of course, we're gonna look at the charts and we're gonna see where our strike price is going to be in relation to a percentage discount, and of course, in relation to support and resistance. And we're gonna compare to what we'll get if we were put the same money that we're going to buy here, one stock or maybe 100 stocks, how much you're going to expand and how much we get for the same DTE of that option. Okay, for the same DTE, we're gonna compare how much we will get if we just put in the bank and collect some passive income with fixed income, okay? So without further ado, let's get on to the video. And don't forget, guys, if you like the video, subscribe to the channel, leave your comments below, smash the like button, and share this video with all your friends. The first one we're going to have a look, it is, guys, bank return. Let me get the pen here in red. So the first one you're gonna do, it is bank return. Let's see how much we get for the money that we're gonna put aside to buy one stock. Remember, you have to multiply that by 100, but in this case, it's gonna be one stock only, okay? So in our example, what we're gonna do is we're gonna use here, let me go back to my freebie, which it is my spreadsheet. We're gonna simulate all the trading. So in this case here, we're gonna use here the IWM, okay? And why now? IWM, if I go back to TastyWorks, IWM, it is trading at roughly $218.93, but we're gonna use here the bid price if we were to buy, because remember, we buy at bid and we sell at ask, pretty much. Of course, we always try to get the mid price, but let's make things simple. We're going to buy at bid price, and let's say that why now, when I did the calculation, IWM pre-market was trading at $220.55. Now let's jump into an online compound interest calculator and see how much we get if you park $220.55 for 53 days. Remember, we have to swap these and change these to yearly times, okay? And we're gonna receive 3%, and you're gonna do that on 12 months compound interest rate. So if we go here to our online calculator, so basically that's how much we put, and that's the price of one IWM shares. Of course, guys, we buy here 100, okay? Because for us to sell an in-the-money covered call, which it is one contract, it's equivalent to 100 shares. This is the time in years. So basically we just divide here, divide here 53 divide by 365. That's where we got this number here, 3% annually. We don't gonna contribute on winning money whatsoever. And after the calculation, our money is going to be worth, after 53 days, it's going to be worth $221.50. And that gives us interest rate earnings of 0.95 cents. Okay, and if we go back here to our calculator, if you go all the way to the end here, this is exactly what I have here. Okay, 22,151, but this is for 100 shares, like I said to you guys, because here in this example is just 100, but if you multiply this by 100, you're gonna be what, 221.50 cents. Okay, pretty much what I have here in this Excel spreadsheet. Let me see if I can go all the way to the end. Here we go. So 221.50 cents, but in this case I already multiplied by 100. That's why it's 22,151. Our rate of return in our calculator online was 0.95. So basically here a little bit more exact, because I'm doing the 53 days by 365, the exact decimal place. It gives us 96 cents multiplied by 100, $96. And our rate on investment, in other words, the return on investment, it is 0.44% for those 53 days. So now we know, before we trade in our covered calls, that we can get 96 cents for 53 days. So if you now we go back all the way down here, if we sell, let's say for example, this strike price 195, which is in the money, $200 in the money, 205 in the money, all the way to 218, which is pretty much at the money, only like few cents below the market price, we are gonna get, guys, this sort of premium here. Okay, but the premium that we're gonna collect, okay, which it is the extrinsic value, as you guys can see, it's way better, apart from the last one here. Forget about the last one. It's way better than the money that we get from the bank. And these are our rates of return. Okay, way better than if we were to put the money just in the bank and collecting the 0.4% in 53 days. Okay, so the first one, which was our calculation to see how much the bank is going to pay us, that's how much we were going to get, which is roughly 0.44 in return on investment. Okay, this is not rate of return of the option. This is just return on investment, which was the $96 if we were to place 22,151 for 100 shares. Okay, very simple. The second one you're gonna have a look, it is premium capture. And when it comes to premium capture, guys, it is very simple, because you need to decide how risk averse are you. We're going to come here, select the 53 DTE. Remember, this is our DTE all the way down here in this column. Okay, we're gonna open this one here, and we're gonna start simulate all the way down here to 195, 200, 205, until we get all the way up here to at the money, pretty much at 218. Why it is at the money? Because Okay, as you guys can see, we trade at $218.92, which is pretty much almost the same as the current market price. Only like what, 93 cents below. So basically it is trading at the money, okay? So if we were, for example, to sell here a call, in the money covered call, we will collect here, let's say we're gonna buy at the bid, okay? Because remember, we always buy at the bid. I know we're gonna get filled here at mid price. That's okay. When we place our order, in our example now, we're gonna use the bid price. But when you place your order, always try to get the mid price. In this case, 26.73. But to make things simple here, we're going to sell, okay, at the bid price. In this case, 26.64 for this option, okay? And the strike price, it is 195 DTE 53. So if you go back here to our Excel, this is exactly what I put here. The stock price, I just update to 220.55. Strike price 195. Number of shares, like I said to you guys, that's why my calculation, okay, was 221,050. Why? Because I multiplied the 100 shares by 100. Because remember, each contract that we trade is equals to 100 shares of the particular product. We're going to open the trade today, 28th of October 2024. The trade is going to expire on 20th of December 2024. And that gives us an expiration date of 53 days, okay, for all of them. We're going to simulate all these trades at the same expiration date. And of course, the same entry as well. The only thing that's going to change, it is the price of the call option and the strike price, okay? Because remember, we are here at 220. The more deeper in the money we goes, the more intrinsic value is going to be, the bigger it is the premium. The up we go, the less intrinsic value is going to be, and of course, the less premium is going to have for us to capture, okay? So in this case here, we collect 26.64, as you guys can see, for the 195 strike price. This was the bid, by the way, okay? And another thing we need to take into consideration here, guys, the IWM also pays dividends, okay? And roughly like what? $3 per year. I actually need to, let me just format this thing here into dollar-wise so you guys can have an idea. So this is how much the IWM pays per year, which is roughly, I think, 3%, if I'm not wrong, if I go back here. So as you guys can see, sorry, the dividend is 1.37 per year, and right now it is $3. So basically this yield here is just the price of the dividend, okay, divided by the price of the shares. If you divide $3, okay, divide by the price right now, I think it's 220.51, you get the yield, okay? Or if you get this thing here multiplied by this, if you multiply both sides here by the share price, of course this cancels with this, and then this multiplied by this share price here, these two, then you get your dividend yield here, or your price with all the $3, like I said to you guys, okay? If you do the share price times 1.37, you get this thing here. So very, very simple. It's just like across math. But why now $3 per annual, okay, dividends? So back here to our spreadsheet. So we need to put here our dividends. Very, very important, okay? And again, this is by 100 shares. That's why at this place here, as you guys can see, we have here the net dividends of $300. Why? Because we just multiplied the $3 by $100, okay? So the second example, so you guys can have an idea, if we go back to TastyWorks again, if we move here to $200, okay, we're going to collect $22.26 for $200 strike price. And if we go back here, this is exactly what I said to you guys, $200, $22, $26, and so on. We don't need to go all the way up here to this strike price here. I'm just going to show the last one, which it is out of the money. But why now? All this strike price here, which it is less than the current stock price, which it is all the trades that it is in the money, okay, of course, you're gonna collect greater premium because there's a lot of here, guys, of intrinsic value, as you guys can see here. Look how much intrinsic value. But the moment we go out of the money, the intrinsic value, it's zero. Because all the option trading out of the money, guys, has zero, okay, zero intrinsic value. All the option will be made by extrinsic value. That's why the extrinsic value here, it is our maximum profit. Why? Because if the option stays out of the money at the expiration date, we capture all the extrinsic value. But as you guys can see here, there's a trend here. So why now? The stock is 220 and 55. The closer we go to the current stock price, okay, the closer we get to the current stock price, all right, the lower the premium is going to be. All right. And why? Because we have less intrinsic value. Because here, don't forget, the difference here between stock price minus strike price, this is, guys, our intrinsic value. And of course, the money that we're going to make when this in the money here, in the money, okay, trade expire or finish, or whatever it is just the left. What is left for us? It is the premium minus the intrinsic value, which it is this thing here, our extrinsic value. Simple. Okay, this is our profit. Our profit, it is the extrinsic value, which it is the premium, which is this thing here, 26.64, minus the difference of these two. And this gives us our extrinsic value. All right, very, very simple. So you guys have an idea. Let's go back to our 195 option. Let me go here to a covered call, which 195 strike price. So if I go back here to our TastyWorks, okay, the 195 strike price, as you guys can see here, 195, we're gonna sell here at the bid, okay, and then this is one contract, by the way, 53 days to expiration. Our maximum gain here, 195. I don't know if the stock had changed the price right now, but 53 days. Our maximum gain in this case is going to be 175. All right. So this is what it's saying here on TastyWorks. But in this case here, okay, let me just redo this thing here so you guys can have an idea. 175, 195 is the right strike price. 195 out of the money. 220.10. Let me see if I can fix here the 220.10. So if I go back here to our simulation, so if I go to the right here a little bit, you guys gonna have an idea. All right, so in this case here, our extrinsic value, all right, let me go back here. So as you guys can see, our extrinsic value here, guys, it is $1.54. Because don't forget, okay, TastyWorks is doing the mid price of the shares and the option. Here, I just got the price of the option and the stock. So you guys can see, all right? So it's pretty much what we're making right now. Roughly 155 to 165, something like that. Because TastyWorks is doing both together. The share price and the core price. But the stock is changing a lot right now. Right now it's trading at 220.08. Now it's gone down to 20.05. As you guys can see, the intrinsic value is gone up a little bit again. So let me format this. So the extrinsic value went up a little bit now to $1.60. So basically, what we're gonna make is just what left between the option premium minus the intrinsic value, which it is the difference between the stock price minus the current stock price. But the things you need to pay attention is how much premium you want to collect. If you want to collect, guys, a greater premium, okay, you're going to have to be a little bit more risk averse. Why? Because your downside protection is going to be way, way less. Because remember, like I said to you guys, we are here at 220. Okay, here you are way down here selling options. and then you get close, you get close, you get close, you get close. That's the way it works. Okay, you're going to collect here less premium, but there's way less extrinsic value too. In other words, sorry, less intrinsic value. You're going to have here more premium because you are more close to the stock price. In other words, you're taking more risk for that trade. But of course, you're being compensated with a greater premium. And that's why here, in this case, here you have out of the money, you got here $5 in premium. A little bit out of the money, $6. Way more in the money, $5. Deep in the money, $3. Deep in the money, 2.58. Very deep in the money, 171. And way deeper, $1.60. And as you guys can see, we have 12% protection here to the downside. So in this case here, okay, in this first case here, the stock has to drop 12%. In this one here, which is out of the money, we're selling pretty much up here and not down here. We have like what, guys? 2.5% protection. But in this case here, it's just the stock price minus the premium. Okay, which is basically 220.55 minus 5.62. That's our downside protection. That's it. But once you go very deep in the money, you can have, of course, you can have less premium, you're going to make less money, but you're going to have a massive protection to the downside. So you need to understand what kind investor are you? Do you want to collect more premium? Are you more risk averse? Are you more into risk tolerance? So this answer pretty much our first two concepts of strike price selection, which it is the premium capture, how much premium you want to capture, because that's why you need to pay attention. That's how much you're going to get at the end of the day. It's not what you capture here. This is pretty much intrinsic value plus extrinsic value. But remember, we make money, guys, on extrinsic value and not intrinsic value. So if you are someone that like to capture a lot of premium, you're going to have to go more close to the current stock price. If you're someone that more risk averse, guess what? You're going to go deep in the money, okay, collect a lot of intrinsic value, but you're going to have way less extrinsic value, but a bigger downside protection. That's how you select your strike price using those two concepts, which it is these two things here. Okay, like I said to you guys, the first one and the second one. In this case here, you need to decide how much premium you want to capture. If your premium is gonna be, let's say, bigger, your downside protection is gonna be smaller, and vice versa. If your premium is gonna be smaller, your downside protection is gonna be higher. Simple. Okay. If you are greedy, you're going to get to a premium that it is higher. If you are risk averse, you're gonna go to a premium that it is lower. But of course, premium lower, downside protection higher. Premium higher, downside protection lower. You need to understand what kind of investor are you, what kind of trader are you. Okay, but of course, all these guys with the long-term investment in mind. Okay, don't forget about that. So the next one, you're gonna have a look. I hope that was very simple for you guys to understand. Of course, I probably could have explained this a little bit more quicker and slower, or maybe straight to the point, but I want you guys to understand what I do myself when it comes to select my strike price for in the money covered call. And I also use this for all my cash secure put options, guys. Very crucial. Okay, so let's keep the TastyWorks like this. And these are the kind of things that you need to have on your trading tools. A simulator like this, I do it in a spreadsheet, and you guys can get access to this on the description below. Okay, if you want to be part of our community, you can get access to all our downloads: trading journal, simulator for cash secure put, how to enter, how much you get, rate of return, is it worth to press the trigger, covered call, trading journal, the wheel trading journal, all those good stuff. Just be part of our community. It's pretty much, guys, supporting our work so we can keep providing free contents to all of you, nothing else. And you can get update of all the trading journal, and of course the new ones that we're going to put together. Okay, the next concept you're going to see is annualized rate of return. So for those 6 trades that we did, which it is these ones here, okay, 6, 7, 1, 2, 3, 4, 5, 6, 7. The first 6 it is in the money, the last one it is out of the money. So what you're gonna do is, this is our simulator in terms of rate of return and annualized rate of return. So let's say, for example, okay, if we collect 2.9 rate of return on the first trade that we did with the strike price of 195, okay, the extrinsic value was, I think, 160, something like that, we're gonna get 2.09 rate of return, annualized 14.37. But if you have here, you put your input here, you can get access, guys, to this simulator, okay? You're never gonna trade in the money covered calls again, because if this doesn't pass your criteria, just don't press the trigger. Because if I wanna get annualized rate of return on my trades of about 22, guess what? None of these trades here will qualify. The only trades that will qualify will be these three down here. The two in the money and the last one out of the money. And the reason why it's here out of the money, guys, because that $5 that we collect, it's all extrinsic value. Simple, okay? This one, as you guys can see, is smaller. And of course, it gets smaller, it's smaller and smaller return. Why? Because here we have a bigger downside protection, okay? Very uncorrelated. So basically, guys, higher premium, lower downside protection. Lower premium, higher downside protection. They are uncorrelated to each other. But if in this case here, my annualized rate of return that I desired for my trades, it is 29.82. As you guys can see, this 29 here, 0.81, they won't qualify. This one here won't even pass. But if I put here 29.8, they'll pass. So you need to know how much we want to get annualized. My goal, as I said to you guys all the time, is to get roughly 12 to 15% per year. If I get 12 to 15% per year rate of return, I'll be amazing, which it is this thing here. Okay, why? Because remember, guys, this rate of return here is just for 53 days. This is annualized, okay? I hope you guys know exactly what does that mean. Rate of return for those 53 days. And this is if you were annualized that trade. This one need to pay attention. Annualized, I'm happy, guys, with anything between, actually, this is not true. Anything between 20 to 30%, okay? So anything, this will be very happy to do these trades here. All right, but my rate of return is between 12 to 15, which gives me roughly 1% per month. Okay, this is my dream when it comes to trading options. And of course, it can be in the money covered call, out of the money, cash secure puts, the covered strangle, the wheel strategy, and so on. But you need to have something like this so you can qualify if your trades pass your entry criteria. Because if you have your criteria of to be annualized of 25, that's the trade you want to trade. If you only want to get, let's say, 12% annualized, you can trade all of them. Simple. Very, very simple, okay? That's the way it works. But like I said to you guys, I have at least 20. So this is the trades that I'll be pressing the trigger. This trade here, I will not be trading them because it doesn't pass my entry criteria, if you guys get what I mean. Or entry requirements, whatever word you want to use. Whatever word you find easy to pronunciate, by the way. Okay? So this is, like I said to you guys, if you go back here to our PowerPoint, this is our analysis in terms of rate of return and the main one, annualized rate of return for you to select your strike price. Because, okay, very simple. Because if you say like these trades here pass 1, 2, 3, 4, if you go back here, okay, so basically these are the strike price that you're going to trade. You're going to trade the 210, 15, 18, 25. You ain't gonna trade the 195, the 200, 205 strike price. You're not going to trade those ones. You're going to trade these four because they pass all the entry criteria, as you guys can see here on our annualized rate of return calculation. This is how you select your strike price using ROI and annualized rate of return, okay? And the other one that we're going to have a look is simple, guys, chart analysis. Of course, you're gonna say, you don't pay attention to chart analysis, technical analysis, fundamental, all the mumbo jumbo. Guys, I don't, but it's good to have a list as a confluence, okay? It is good to have a list as a confluence. And if you come here to the trading view, we're going to analyze here the IWM. So as you guys can see here, I have my indicator here that I built myself that gives me the price for whatever percent discount from the current stock price it's going to be. If the stock drops 7.5, That's where my strike price has to be, 202, for me to be safe. If it's going to drop 20%, that I think is going to drop 20%, I need to make sure my strike price is below or above whatever strategy I might be trading at 175. If I'm trading and I think the stock's gonna drop at 40%, this is the stock price is going to be. If I'm selling a cash secure put, I need to have my strike price below 131. Okay, and so on. All right, this just to show you what I do myself. And of course, I got other indicators here. So basically, what you're gonna do is, okay, if of course, I'm just using the chart here, but you guys can apply the RSI when it comes to oversold, overbought. Let's say, for example, this might be getting close to overbought. This might be getting close to oversold. This pretty much trade in a range, as you guys can see. The IWM, guys, is a cash cow business. Especially if you have a strategy that you make money with the price going up, like myself, price trading sideways, and price trading down, but doesn't touch a strike price. If you want to learn all those things, guys, join our community. Because if you do not make money this way, I'm sorry, I'm not a financial advisor, but guess what? You ain't gonna make money anywhere whatsoever. There's no gas, there's no prediction, there's no gambling, none of this kind of nonsense. And by the way, we invest long term, we trade derivatives for the long term in mind, with the long term in mind as well. Because remember, derivative is just a way for us to get into stocks for the long term. And of course, we do speculate in cryptocurrencies in our community as well. If you're out of cryptocurrencies, I'm sorry, my friend, you don't know what you're missing. Okay? We made a lot of money trading cryptocurrencies 2020, 21, 22. And of course, we now just being patient because nothing's moving whatsoever. We don't do those scam, guys, those nonsense meme coins. We don't do on a daily basis chasing for unicorn. None of that kind of nonsense, okay? Buying our crypto and just sit in our hands, nothing else. But let's say, for example, we're gonna sell a covered call, and then we might look here and think, you know what, I'm gonna put my strike price around this level here. Because if it falls and trade all the way down here and retest the support and maybe trade, let's say, just at my strike price, guys, I'm gonna capture all this intrinsic value, okay, and the little bit of the extrinsic value. I'm gonna capture the whole thing. If it drop here 12%, let's get the ruler here to make things easy, okay? 12% all the way down here. All right, if it drops 12%, I'm going to capture all this extrinsic value here, okay, plus the intrinsic value. If it drops to 195, remember, the 12% pullback was the strike price of 195. Don't know if you guys remember. Okay, let's go back there so you guys can remember what I'm talking about. Okay, 195. Okay, and that was our 12% pullback. Okay, back here to our trading view. So if I put here my strike price at 12%, if I look back, maybe this is gonna hold, this is gonna hold, this is gonna hold. There's plenty of support at this level. So I can look at the chart and say, you know what? 12%. Let me look at the chart. This might be a good place to put a support, because if the price do come down, retest that support, and maybe just close a little bit below, of course, I'm going to start to lose money on the share price. But I'm going to capture all this extrinsic value. Okay? And of course, it has to pay. It has to pay for the difference of the share that I bought, because I bought with this price here. Remember, there's no free lunch, guys. This is no free money. The money you're going to make is all the extrinsic value. The intrinsic value here is just what's going to help us in terms of downside protection. That's it. Because what we're going to make here, intrinsic value, is going to pay off with the losses of the share price. Okay, but if it is, okay, oversold, let's say like here, for example, we sell a in the money covered call. If the price goes up, thank you very much. That's what we want anyway, because we're gonna capture that little bit of extrinsic value. Like in the first one that we saw, the strike price of 195 was roughly like what, $1.60. Okay, so you can look at the chart, and if you find supports like this, it's a nice place for you to trade your in the money covered call. And when the price pretty much on the pullback, it's even better. When it's trading the all-time highs, it's not a great idea. Okay, it's good to sell in the money covered calls on at least pullback from the all-time highs. Let's say, for example, the price went all the way up here and pull back, let's say 16%, great. At this point here, you didn't know if this thing was going to keep selling off. You don't know. That's fine. There's nothing wrong with that in my point of view, because you can do a lot of stuff here to manage your trades. Then once the product do recover, you can close your trade and gain all the profits. Of course, you can roll the trade, you can manage the trade, and I'm going to place more content in our group so you guys can learn how to manage your in-the-money covered call, because might be, guys, one of the best strategy you can ever find when it comes to trading options. Okay, so chat, it does help. It doesn't mean it's gonna hold, because here it holds very well this level here, but could easily, guys, broke. Like say for example, hold here, hold here, hold here, hold here, and bang, broke. Okay, it's not always 100%. It's just to give you guys an idea as a confluence, and that's it. That's what technical analysis is supposed to be used with fundamental as a confluence. What's going to make us money? It is the long-term investing, our LTI, that we do cover and we do propagate and we do talk about in this channel. Okay, so going back here to our analysis, don't know if I have here, going back to our PowerPoint. Let me just clean this thing here. Nothing here. Let me go back here, guys. Okay, I'm just pressing the wrong thing here, that's why, sorry about that. So let's go back to our PowerPoint. So the last one, like I said to you guys, was just the chart analysis. So these 4 things here are the things that you need to pay attention and ask yourself what you want to do in terms of opening your trades. Of course, combine it with a nice simulator like you saw on the spreadsheet. You can get hold of the spreadsheet, guys, on the first link of the description below, and all the other 10, 15, 20 that you're going to be able to download as well in our community, and you get all the updates, all the new ones. You can ask questions, ask you to add things, all those good stuff. We're going to build the best investing and trading community on YouTube, okay? And I'm going to provide all these things for you guys in our community. It's pretty much, guys, it's just priceless. People probably charge this thing like, I don't know, hundreds and $100 for these things. But anyway, so the premium capture, again, there's no free lunch, bigger premium, smaller protection, smaller premium, bigger protection. Are you greedy? Are you more risk averse? What kind of investor are you? Rate of return, for me, one of the best one, if not the best approach in terms of selecting the strike price. And of course, you can apply as well, and you can combine a chart analysis, okay? And you can see in terms of the bank, how much you're getting. If you're getting here like we were, let's say, 0.44% on our return on our money, and we're getting here on the first one, which was 2.01, guys, there's no point to put our money on a fixed income when you can make way money trading in the money covered call, if you get what I mean, okay? But you must have a simulator so you guys can have an idea what you're going to trade and how you're going to trade, okay? And of course, you need to also have a trading platform, okay? If you want to join TastyWorks, we also do have a link on the description below, or you can just go to TastyWorks website and be part of the TastyWorks open TastyWorks account and start trading with TastyWorks or Interactive Brokers or Schwab or whatever broker you might like. That'll be the second thing you need to do as well, which you open, of course, your trading account. But when it comes to selecting the strike price for in the money covered call, guys, it is those 5 things: premium capture, risk averse, rate of return and analyze rate of return, chart analysis, and how much you're getting at the bank. Then you can compare with this return here and see if it's worth to press the trigger or not. Okay, this was a quick video to answer the question of this viewer here that asked what to do in terms of selecting the strike price and the underlying. The underlying, guys, very simple. Stick with the ETFs, stick with the index, stick with futures. Simple. Don't complicate things. If you're more advanced, guys, you can go to those blue chip stocks: Nvidia, Meta, Amazon, Google, Apple, and so on. Okay, if you do this thing here on meme stocks, GME, AMC, whatever it is, you're going to burn yourself. You're going to lose all your money. Simple. Period. Okay, or you stick to ETFs. At least you can go to sleep and say, you know what? If shit hits the fan, I can at least turn that to a long-term investing, and I can keep managing my trades, okay? And of course, like I said to you guys, learn how to trade options for free, by the way. And don't forget, join our trading community in the first link on the description below. You can download all the spreadsheets. There's plenty, guys, you can download and get access. And of course, you can ask questions, things to add, things like that. We're gonna build the best trading community online. Okay, guys, thank you very much. I do hope it answered the question. Sorry that I pretty much mumble jumble too much, but I want to make sure that I was clear on every single thing so you guys can learn and can understand what I'm talking about. Of course, this is not the business or the end of everything. There's plenty of other ways you can approach the in the money covered call strike price selection, but these are just 4 or 5 things that I do myself, which you can also combine with other things that you might know already. Okay, I hope I have added some value to you guys. Sorry for being too long on the videos, but I like to go things with step by step so everyone can do understand. Okay, thank you very much for everything. Don't forget, subscribe to the channel, leave your comments, smash the like button. This helps us to grow our channel and keep providing free content to all of you. No matter where you are in this world, I wish all of you all the best. Stay safe and happy investing.